All right. Well, we're live, Wayne.
We're live.
Live. Well, thank you everyone for joining us today. We have a really special guest for you. My name is Christina Gamache. I'm owner of Audax Wealth Management, and I am so passionate about helping business owners increase profitability, pay themselves, and get ready for the next chapter, whatever that might be. And I have this little LinkedIn live series called The Board, as in the Board of Advisors, for especially for business owners. Because as a business owner, I know that you are just swamped with all of the day in and out pain points and things that you have to deal with. It can be very lonely. And who do you go to? Who do you listen to in order to get that knowledge and get that information? Well, today we have Wayne Slavitt, my good colleague, and he is a master at maximizing business value. So thank you, Wayne, for being here. I really appreciate it.
Well, the pleasure and honor is mine, Christina. Thank you very much for including me.
Yes. And if you guys are here today, let's see. Oh, we got Shelly here. Hi, Shelly. Tell us where you're from. Drop it in the comments. If you have a question, please put it in the comments and we'll get to you as soon as possible. We want to make this interactive and we want to know what's pressing on your minds. All right. So Wayne, let me introduce you properly, right? We're going to read a little bit on your bio. So for the past 40 years, he has been CEO, CFO, corporate controller, company founder, consultant, you name it. This guy knows what he's talking about. And he works with companies between about 10 million and 100 million in revenue to really set them up for a successful exit. And that's what we're going to be talking about today. He has a new book out called, I just had it, Run It Like You'll Sell It, and maximizing the value of your business by adopting the seller's mindset. Is that right?
Yes, that's close. Very close.
Okay,
we'll take that. We'll take that.
Thank you. So let me set up the scene for our business owner clients here. According to the Exit Planning Institute, which we both have our designations from, only about 20 to 30% of businesses that actually try to sell will sell. And that's a very discouraging number, right? So almost 80% of our small businesses out there in America are not going to be able to really harvest the wealth that they are so hard for day in and day out. Small Business Development Center calls any small business like less than 74 million in revenue. And I know that different people have different opinions on what is small and what's medium sized, right? But a lot of these small businesses employ most of America, right? More than, I think, exactly 64% of employees are employed by small businesses. So now we have these business owners who are just giving so much of their blood, sweat, and tears to their business. They're helping employees, they're helping their communities. And when they go to exit, they're not going to be able to reap the benefits of all of these years of hard work. So Wayne, I want to ask you, why is that? Why don't these companies sell for what they should?
Well, Christina, there's really a number of reasons, but I will tell you the one that floats to the top. The number one reason that I've found over the years, in studying exiting strategies, the number one reason is the lack of preparedness. The business owner doesn't take the time leading up to the time that he or she sells the business or wants to sell the business, and woefully the business is under prepared to be able to be ready to sell, and that lack of preparedness then puts the owner behind the eight ball. Because what a lot of times will happen, if you're lucky, and you mentioned the statistic that about 20% of the companies that try to sell each year are successful. That means 80% or 4 in 5 are not successful. And that means they're not going to achieve the liquidity event that they're hoping to. But the ones that are able to sell, they might get an unsolicited offer from a competitor or a private equity group or someone looking to expand. And if that business owner who gets that letter is not properly prepared, then they are going to be surprised once they get into the transaction when the buyer finds out that the company's books and records might not be that good a shape. They might have customer concentration issues, any number of things. It's a laundry list of things that could be a problem. And that then causes a buyer to either back out of a sale or significantly reduce the price of the company. And that's something we really, really want to try to avoid. So in answer to your question, preparedness is the number one thing.
Preparedness, right. Yeah, and even when COVID first kicked off last year, right, a lot of the companies couldn't get that first round of PPP loans because they weren't prepared. It's not because they weren't qualified. It was because they weren't prepared, right? So on the financial side, it's very important to always be prepared, right?
Well, I was just point out one more thing, that the sale of a business or the exiting from your business is a guaranteed event. It will happen. And as you know from our training with the Exit Planning Institute, we know that a business owner is either going to exit his or her business horizontally or vertically. One way or another, that person is no longer going to own their business. So if that is inevitability, why not plan for it? Why not take that step to be ready for it?
And why not start at the beginning?
Yes.
Well, I know you have a little PowerPoint presentation to share with us. So if it's okay,
Sure.
I'll go ahead and throw it up there for you.
Sure. Yeah. The first thing you'll see on the next slide is making sure that we know what your needs are. That's probably the most important thing. So go to the next slide if you could, Christina. There you go. And we already talked about the 20%, that only 20% or 1 in 5 companies that go to market each year are successful. And I equate that to baseball, that the season just ended. But if you batted 200, you would probably not even make the minor league team. So we want to be able to take that 20% and make it a much higher number. So let's go to the next slide. And we talked about preparedness. And in my new book, that's one of the main themes, being prepared for an event you know is going to happen. So let me give you an example of that. Christina, go to the next slide if you could. And I like to equate the sale of a business to what you might do to sell your home. And let's say, for example, you wake up this morning and you say to yourself, I think we're going to sell the house. Well, would you immediately today, put that for sale sign in the front yard and see what happens? Most likely not. You would contact a realtor. You would invite the realtor to your house to walk around the property, taking notes of things that needed to be fixed. You would invite the realtor inside your house to walk around. The realtor might make a note of, chipped tile in the bathroom, maybe staining of the carpet, little things that need attention before you're going to invite in potential buyers. So if you would, and by the way, no one's ever argued with me that that's really how you sell a house, unless of course you have to sell it immediately. But if you have a little bit of time, you're going to do what it takes to make sure the house is in good condition. So if you go through that process, if you go through the process to get a house ready, why wouldn't you do more for what is most likely the most valuable asset that you own? And let's go to the next slide, Christina. For most business owners, for most of the clients that I have and that Christina talks to who haven't yet sold their business, the bulk of their wealth is tied up in their company. And they're waiting for this liquidity day to be able to cash in and be able to live the rest of their lives in a very, very nice manner. So once again, if that's your most valuable asset, if that's where most of your cash is tied up, then let's do it right the first time. And I always like to use these sports analogies, but we only have one chance to hit a home run. So let's swing for the fences on that first shot, and let's make sure we're doing everything we can to be successful. So let's go to the next slide, Christina. People call me up and they say, Wayne, I'm thinking of one day selling my business. When should we start? And to each and every one of those clients or potential clients, I give the exact same answer. And the exact same answer is today. We need to start the process today. And I'm giving you an example here on this slide of a runway. So if you will, give me a little bit of poetic license here to compare the runway to time. And if I have a very long runway, what size plane can I land on that runway? A very large plane. So if we equate the runway to time and the size of the plane to the value of your business, it only makes sense that the more time we have, the greater the value you're going to get for your business. And I've seen it time and time again that I'm at a point now where I guarantee my clients that we'll be able to grow the value of your business if you give us a reasonable period of time. So let's go to the next slide, Christina, please. And this is our goal. The whole point of the exercise is to really accomplish one major goal, and that is to maximize the value of your business. Whatever it's worth today, we want it to grow by the time we take it to market and introduce buyers. So I'm often asked, well, what is value? What is business value? How do you compute that? And maybe some of you in the audience have been through a formal business valuation, that 100-page document that no one understands, and it's very complicated. Let's go to the next slide. I break down business value into two variables, and we focus on that with my client. And I tell my clients that business value is made up of two variables, the first one being profits, and we can look at profits a couple different ways. And offsetting profits to determine what the value of your company is business risk. So there's only two factors. And every one of my clients is instructed to only worry about those two factors. We're not going to talk about complications of valuation such as discounted cash flow and weighted average cost of capital and all kinds of things like that that really don't make any sense in the end. So I focus on just those two things. So we're going to do all we can with your help and with the help of your team, if you want to involve them, to try to grow profits. So we're going to look at all revenue opportunities. We're going to look at cost control if possible. And what we're going to want to do is demonstrate the ability of your company to grow profits over time. So let's go to the next slide, because now I want to talk about the aspect of business risk. Business risk is very, very simple. And let me tell you my definition of business risk. Business risk is any aspect of your business that will prevent a potential buyer from predicting your future. Now, there's a lot of words there, but what it really means is the unknown in business is not your friend. So what we're going to try to do with our own proprietary risk assessment scorecard that I developed, it's got over 140 questions on it, and we'll look at 22 different areas of your business. And what we're going to try to do is identify and then eventually reduce or eliminate as many factors of risk as possible. Because on that formula that I showed you, if I can lower the denominator, the value is going to go up. Okay, so let's go to the next slide. And by the way, if this is too fast for any of you, buy my book or I'll send one to you. But let's talk about the first things we do with every one of our clients. We do what I call the first 5 steps. And it includes obviously 5 things we're going to want to do, mainly to gather data and to do some assessment and diagnostics on your company. I want to know when we start, where are you at? So the first thing we're going to do is we're going to look at your financial statements. And we're not just going to look at them and throw them on a spreadsheet with a pretty color and a nice font. We're going to compare your financial performance to that of other companies in your very same industry. I want to see where you stack up. Are you above the average? Are you below the average? Because that's going to have an impact on valuation. The next thing we're going to do is what's called the recast analysis. Now, those business owners that are listening to me right now, I'm sure none of you have ever run any personal expenses through your company. I would imagine that company credit card is only used for company credit card or company expenses and never for personal use, right? Wink, wink. We all do that. What we're going to want to do, though, for the purpose of understanding your true earnings capacity, is we're going to add back those items that are non-recurring in nature, a bit discretionary in nature, and market-based. Maybe you're being paid a little bit above market, or maybe you've got some people who are never coming to the company, but they get a paycheck every month. We're going to eliminate those costs. That's going to raise your profits and therefore your value. The next thing we do, we mentioned the risk assessment. From that risk assessment, we're going to develop a prioritized action plan to address initially the most important risk factors. So we're going to try to take those and we're going to look at them in 90-day sprints. We do it in 90-day sprints to make it digestible. And I've owned many companies. I know what it's like to own a company, and we want to make our job helping get ready to sell your company as painless to you as possible. So we're going to do the action plan in 90-day sprints. And the final thing we do is we're going to do a topside business valuation to understand what your company is worth today as a benchmark. And what we're going to do is we're not going to look at these fancy formulas. We're not going to do complicated forecasts. We're going to simply look at what kind of multiples other companies in your industry have sold for over the past couple of years. That's the first 5 steps. This is going to take about 30 days, and we're going to have a lot of good data to be able to sit down now and map out the next couple of years. So Christina, can you please advance the slide? We keep focusing on maximizing business value because at the end of the day, that's what matters most. What is your company worth? What can we get it to grow to? And how can we get a buyer to understand the true value of your company? Next slide, please. Today's the day. Those business owners who are out there who are thinking of one day selling their business, get the process started today. Let's at least have a conversation. We might not start the process today. And I have a client who just retained our firm last week, and I've been talking to her for 6 years. Sometimes it takes a while, but she finally woke up a couple of weeks ago. She woke up and she said, I can't do this anymore. And I really wished we could have started with her a couple of years ago when she still really loved her business. It's a very profitable business, very successful business, but she's now at a point where she can't do it anymore. So we now are engaged in accelerating the process of getting her ready for sale. And I can tell you, we're not going to be able to do as effective of a job as if we had a couple of more years, but we're still going to work hard for her. So get the process started today. Next slide, please. And Christina was so nice to mention my upcoming book. It's being finalized right now. I think the printers they're putting it in the box right now, getting ready to ship it. It will be available on Amazon eventually. They're hardcover with dust jacket. They're a nice book to keep on your desk as a reference. I left about 8 pages in the back for notes if you want to write notes on there. And I'm hoping it's going to be a good reference book for business owners. Christina mentioned that I am addressing in my market area companies between 10 and 100 million. It's really 5 to 100 million. So a lot more companies now can be part of this process. And I'll have my email address up on the screen when I'm done. And if you want to send me an email requesting a copy of your book, please do it. And I'll be happy to send one to you. If you are a company owner with revenues between 5 and 100 million, or if you're a professional, a CPA, an attorney, a banker who has clients in that category, I'm happy to send a copy of the book to each of those people also. As you can tell, I love what I do. I think I'm good at it. I've been doing it for a while. My business is all referral. And if you have a company that sounds like you want to talk about what we're doing to see if maybe it would make sense for you, please let me know and be happy to help out. And with that, Christina, I think we can take questions if we have any, or perhaps you have some questions yourself.
Yeah, thank you. So let's go here. Yep. Shelly is very excited about this new book. I am too, Wayne. I can't wait to read it and gift it and just put it out there because I don't think that this concept is talked about enough. I think that it's something that people procrastinate on. And, in a perfect world, all of our clients would start the planning process at a very early stage in their business, right? Kind of like planning for retirement. You start early, you end up way ahead of the game.
Sure.
Doesn't always happen like that, but I appreciate you coming out and giving us this quick presentation. I do have some questions for you if you can stick around for just a minute.
Always happy.
I loved how you simplified such very complex terms, right? So profit and risk, right? We can dig into that all day long. It would take a long time, but you put it in a very simplified manner, which I thought was wonderful.
Thank you.
So for profits, right? Profits are not revenue. It's not the same thing.
No.
And I think that's very important to distinguish for business owners, right?
Yes.
And then same with risk, there's all sorts of different kinds of risk. And you kind of touched on it. Risk is not bad inherently.
No.
It's the unknown risks that can be very detrimental to any situation.
You're right. And and most companies, if they didn't take on risk, they wouldn't achieve the greatness that they've achieved, right? So you bring up an excellent point that we really want to distinguish the risk of going into business and achieving great things, swinging for the fences, maybe swinging out or striking out. But the business risks I'm talking about are areas that will harm the process that a buyer is going to put you through. It's called due diligence. And once you decide which buyer you want to go forward with, then they're going to start spending some very serious money on the due diligence process. If they discover things in due diligence that you failed to communicate, it's going to negatively impact value. And we don't want to have that happen, because I've seen examples where business owners contact me and say, I've gotten an offer for $15 million. Can you help me close my transaction? And I said, sure, I wish I knew you a couple of years ago, but that's a whole nother story. But let's go through the process. And once we now get into due diligence, all kinds of issues are coming up that the buyer forgot to be told by the seller. And it's disheartening, because for someone that thought they were going to be getting $15 million to their company, they now are only going to get maybe 10 or 8 or 7, or possibly the worst thing is that the buyer decides they're going to walk. And now that seller who was thinking he or she was going to get out in a couple of months now has to get back in the company and run it for another cycle. So risk can be very good. And I admire, I've started several companies myself, some that I know my wife scratches her head and thinks, what did you do that for? It's risk is fun. Risk could be good. So you're right. I don't want to just discourage people to take on risk. But if you're going to take on risk, make sure you understand what the implications are.
So can you talk real quick then about the 5 areas of risk, the 5 Ds?
Yes.
Places where business owners should really kind of pay attention to.
Sure. So there's 5 Ds of risk or of negativity. The first is, we talked about, leaving your company horizontally. So the first is death. Then there's disability. There's divorce. There is disagreement and distress. And any one of those factors could cause, and every day does cause, business owners to decide to sell their company. If a husband and wife are getting divorced, many times they have to sell the business as part of a settlement because they don't have other assets to divide. A disability, if God forbid you have a stroke or a heart attack and can no longer work in your company, that may also cause you to have to sell your company. So these 5 Ds are very real. Christina and I have both had clients who have been in those kinds of situations. It's something we want to try to avoid, because if you have not properly prepared your business for sale prior to that, I can guarantee you're going to leave money on the table. Can guarantee it.
Yep. And so what about owner dependency? I know that's not technically a risk, but there are so many owners out there who say, oh, I can't even take a vacation because the company would just be a disaster when I return. How is that bad for the company?
Yeah, and in fact, it is a risk. And in fact, it's probably the most common risk that I see. So I told you that I put all of my clients through the first 5 steps. And one of the steps is a risk assessment. And one of the questions that I ask is the owner integral to the business? And we talk about that. What does that mean, integral, what have you? And you gave the good example that the owner can't even take a vacation. Many cases can't even be absent a day or two from work. And think about from a buyer's perspective, because that's what I try to get my clients, my selling clients to understand. Put yourself in the shoes of someone who might be buying your company. You're going to buy the company and hand over to someone a check for $20 million who worked in that company since day one. Do you think that person is going to work as hard the day after the closing or the month after the closing or a year after the closing with that money in the bank? It's not going to happen. And in many cases, it's a very short-lived tenure where the person decides, I don't need this anymore, and I'll leave. So I work with business owners to identify that risk and then to help them recruit either internally from their existing management team or externally where we have to go recruit someone and groom that person to be the successor to run the company. Christina, you can imagine that is much easier said than done. And the risk in terms of being wrong, choosing the wrong person internally or having to hire outside someone, it might not be the right person, in which case we have to start that whole process over again. It could take a year or two before you find the right person. So that's a very, very important risk factor. And buyers do not like uncertainty. And this is an uncertainty factor.
Yep, that's very true. We have a question in the chat. Stephen asks, what are some of the warning signs of companies that are not ready for sale? This is a really good question.
Mm-hmm. So that's a great question, Stephen. And I will tell you that those areas are different for each company. There are similarities, but I would say if we go through in your company, we do the risk assessment, we will identify those areas that need to be addressed before we can go to market. And what will happen is after we do the risk assessment, we produce a report. And the report goes to each item on the risk assessment that the company, if you will, failed, where there is a risk present in that particular factor. So we will then put together that report and sit down with the owner to say, let's discuss the areas that we need to address before we take the company to market. And remember what I said earlier, if we don't do that process, some people don't have time. Christina talked about the 5 Ds. Let's say you have a gun to your head and you have to sell the business, then just know that you're going to be going to market with known risk factors that a buyer is going to look unfavorably upon and will likely reduce the price or cancel the deal. So it's unique for each company, a lot of similarities, but we want to ask you as a business owner about 140 questions, and I guarantee you by the end of that, it takes about 2 hours. At the end of the 2 hours, you'll know more about your company than you ever thought you knew. And the reason I know that is that's the feedback I get almost every time I do a risk assessment. I apologize to the client by saying, I'm sorry we took up 2 hours of your time. And they say, are you kidding me? I learned more about my business than I ever knew. So it's a real benefit.
A big eye opener, right?
It is, very much so.
Yes. Well, okay, another statistic here, last one, right? EPI says that 79% of business owners right now today don't have a formal written plan.
Mm-hmm. If
I'm an owner, what is an easy, simple step to get started today?
An exit plan is a very defining and difficult document to create because it's an admission on the part of the owner that their tenure is coming to an end. So my approach is, and Christine, I know you do this also, is ask the business owner, what is it you're looking to do? What's next? We're dealing these days with a lot of younger business owners who want to sell. So I want to find out what they're looking for. I want to find out what they're hoping to accomplish. Do you have a price in mind? Do you have a plan for what you want to do after you sell your company? Do you want to stay on? Do you want to leave? Do you want to go do something else? I have clients who have sold their companies for sizable amounts of money, and within a month, they're starting another company already. And so it's important in terms of having an exit plan, because almost 80%, 79% of companies don't have exit plans.
Right.
That's a travesty. That's no roadmap on a trip you're going to be taking. So who would want to do that, right? Turn off the navigation and I'll go wherever I want to go? No way. We want to have a plan. Because what do we say? We say that those who fail to plan, or those who, no one plans to fail, but many people fail to plan. And we want to make sure that's not you, because the consequences are too great. You have that one shot at being able to hit the home run. And if you have no plan of how you're going to do it, you're likely going to strike out.
Exactly right. Well, I know we're out of time. I try to keep this to 30 minutes exactly because business owners are busy. I really want to thank you, Wayne, for joining me today. I've got your website here, right? If you have any questions, go to primarkgroup.com. Wayne's new book is Run It Like You'll Sell It, Adopting the Seller's Mindset to Maximize the Value of Your Business. I hope I got it right that time.
You did. That was perfect.
Thank you. And everyone have a great day.
Thank you, Christina. Thanks.